Well, welcome back to Finance Uncut. On today's episode, Billionaire says buy gold, silver, and commodities. Ray Dalio has been warning that if you don't own gold, you know neither history nor economics. And with recent warnings from many billionaire investors and former central bankers about inflation, now we've got another billionaire, Paul Tudor Jones, giving us another warning, but also advising us what to do, how to trade, and how to invest. Let's cut to a recent clip about his warning on inflation and how to hedge against it.
Here's the real question.
Right.
If things are bad-ass crazy
right
now, and you are a trader, not necessarily even a long-term investor, but a trader, let's just say you're thinking about where to put your money. I'd actually love to hear about it in the context of being a trader, but also actually as a long-term investor. What are you supposed to do in this environment?
Well, I'm going to watch the Fed on Wednesday. If they treat these numbers, which were material events, they're very material. If they treat them with nonchalance, then I think it's just a green light to bet heavily on every inflation trade. The idea that inflation is transitory, to me, is that one just doesn't work the way I see the world. So I look at $88 trillion of assets under management by asset managers. Of that, $670 billion are invested in commodity indices like Bloomberg Commodity Index, Goldman Sachs Commodity Index. That's about 0.75%. If I rewind just to 2011, when inflation was peaking at 3%, not CPI at 4.9, those same investors had 1.2% of their assets, which would imply today, if they just got back to weight, another $400 billion of buying in commodity indices. And if you certainly the impact models that we run would argue that GSER or BCOM would double or triple. So you've got, if I just look at where asset managers are, 60-40 types, the one thing that they should be invested in, they're not invested in, probably because they're hearing these assurances that inflation's transitory. So you've got this massive short, really, in the commodity complex, a massive short there. So that makes me think that, and I'll look at the balances in a variety of commodities, and they're all so razor thin. They're all so razor thin. And this is just what happens if institutional money would get to where they should be, given the level of real rates. What happens if the Reddit crowd ever gets into commodities? God forbid if the bullies, the financial markets, ever were to take it on, for instance, like retail did back in the 70s.
Explain what you mean by that.
What I mean is that commodities are finite supply, small markets, generally speaking. And if we ever get an inflationary psychology, like, for instance, we did when I was in my 20s, back in the 70s, if we ever get that again, and if you ever got retail actually nervous about inflation, then the one thing that leads inflation, which is commodity prices, it's the easiest tautology there is. Those things can literally scream double or triple with no problem whatsoever.
So you're worried about the Reddit crowd getting involved in commodities right now?
No, I'm saying that right now, I would be a lot. Look, I think I'm the most conservative investor in the world. That's a hedge fund manager by definition. Hates risk, loves edges, loves competitive edges, does great reward risk trades. I would be really concerned about arguing that inflation's transitory when I know that you've got. Look, think about it. We have a just-in-time mentality. We have inventories at record low. We have demand screaming, and we have people who are really underinvested where they should be, given the valuations of a variety of financial assets.
You said if the Fed doesn't make any moves this week, that it's going to be a green light.
Well, for me, it would be a green light.
But the question is, so it may be a green light temporarily, but you're also suggesting that there's going to be a hard stop at some point. that it's going to create an even bigger problem.
Well,
and so how does a long-term investor think about that?
Listen, I have maintained, I'm so happy I don't have to run a pension fund. I don't know how you'd invest those assets when valuations for both interest rates and stocks are at, if you combine the two, they're so overvalued. They're at 100-year highs. I don't know what you do. I know one thing I'd want to do is the one thing that can hurt that is inflation. I'd have as many inflation hedges on as I possibly could. I sit on, the investment committee of these not-for-profits, and it's really difficult to try to explain to some of the board members of our not-for-profits, gee, maybe now's not the best time to be invested in a variety of finance. Maybe we should own commodities at this stage of the game. Right. Can I just say one last thing? The December 2018 meeting, if you think about that meeting that the Fed had with pretty much the same board makeup, they had a lot of incoming data between that meeting and the one prior to that. Stock market was down 12%. GSCI was down. Commodities were down 20%. The credit markets were frozen. But they went on and hiked because they were locked in to this linear belief that I can have a forecast and that we should stay with it. The predictability was more important than reactivity. So I think they had the same, and 7 months later, they had to reverse course and take that back. I think we're confronted with exactly the same situation right now.
US producer price index is now 6.6%, and this is a leading, I wouldn't say trend, but this leads into consumer prices. So I'm expecting consumer prices to pick up as these producers pass on the costs. I can tell you just here in Australia, talking to a major Queensland and Australian builder, as of the 1st of July, steel prices are going up. I think it was about 17.5%, so nearly 20%. That's now being passed on. So steel for a new home is going to go up several $1,000s come the 1st of July. So these producers, whether it's in the US or Australia, are passing on these costs and are starting to pass on these costs. And I've said it before in other videos that a lot of this is not transitory. A lot of these prices are not coming down. They are built in. So looking at the different trend models, I wouldn't be surprised if we actually see CPI hit over 7% shortly. And I've got a video following this video where, once again, another billionaire is actually warning what the true inflation or CPI rate is. And John Williams from Shadow Stats just did a recent interview as well about the true CPI figures and how dire this is, and really how to protect yourself against it. And there's actually some things that I've picked up that I have actually just implemented. So in my next video, I'm going to share that and share exactly what I've done. I'll touch on that a little bit later in this video. Also, when we look at basically looking at the stagflation index, so small businesses are struggling to fill job vacancies and are forced to pass on higher labor costs and I've said before that with the unemployment benefits that are happening all around the world, people are being paid around $17-18 an hour just to sit at home. And so small businesses, all businesses really, are going to have to increase wages to get people to work. And once again, I don't think these are transitory. These type of increases. And the UN Food and Agricultural World Food Price Index is rising, and it hasn't been this high since, you can see on the left-hand side there, where we had society unrest, and I won't say much more because the tubes won't like it. But if you're watching this, you can know what to think. Also, what's interesting now is that fund managers aren't owning bonds. In fact, this is the lowest in history that fund managers are owning bonds. And I've been saying for a while that this is the biggest bubble going around town. And why would anyone, knowing what is happening to inflation, why would anyone own any sort of bonds? I've got a video coming up where we're going to have a look at the junk bond and corporate bond markets, which is just insane, and the ramifications of that. And you all know I'm on the inflation bandwagon. However, I've also shared videos where I've compared to 1973-74, where we had CPI above 12%, 12.5%, where we had a 50% nominal crash in the stock market. And there's some huge concerns in that play. And I'll also share some stuff coming from some other billionaires also that are making a similar play. So with that, we're also seeing that foreigners are deserting US Treasuries. At the moment, the majority, the biggest buy is the Fed and pension funds. You heard Paul Tudor Jones talk about he'd hate to be a pension fund right now, a pension fund manager. Wow. I'd hate to be a pensioner. I'd hate to be receiving a pension. I really feel sorry for a lot of people. A lot of people are about to get hurt and have no idea. But with the Fed buying so much US Treasuries, I also just saw a report today that Rowan, no, I'm not going to say his name. Bugger. Rowan Gray. He's another Aussie guy who's advising the Fed on the Fed coin and central bank digital currency. Was just at a congressional hearing and has been able to brainwash some Democrats on the very far left. I won't use their names. And now brainwash some Republicans. And this is happening. And so the Fed, so he argues we don't need commercial banks, that everyone can just have an account with the Fed. The Fed can create legal tender, which is what Dr. Lacey Hunt, who is probably the big deflationist, said he will jump ship and not just jump on the inflation bandwagon, but jump on the hyperinflation bandwagon. It's coming, folks. It's coming. Go Google it. Go check out that congressional committee hearing that just happened, where we had MIT there that are working with the Fed at the moment, and you had the Australian Rowan Gray. If you want, go Google a debate that Rowan Gray had with Professor Bob Murphy on Bob Murphy's show. It was from maybe 2 or 3 years ago, maybe even not that long ago. It's a 3-hour debate, and this is where my eyes really opened to the whole MMT and what it's all about. When you just peel back the layers, and then you find out what it's truly about, and it's awful. But guess what? Republicans are now being brainwashed because apparently they like what they heard at this hearing. And anyway, so it's coming. And so, yeah, Dr. Michael Burry and Professor Richard Werner, who have called for hyperinflation 2023, could well end up being right, because they might be joined by the biggest deflationist of them all, Dr. Lacey Hunt, who said if this happens, he won't turn inflationary, he'll turn hyperinflationary. And the Fed's ownership of Treasuries just continues to rise. So not at the pace that they were last year. And remember, it was the repo crisis in September 2019 where it bottomed out, and they really actually started, doing QE again. But they're still doing it. So how do you hedge against this stuff? Obviously, I've been, this channel is all about Austrian economics and sound money, gold and silver. Silver being money throughout history, and gold being a store of wealth. That is my position. That is why that's the foundations of this channel. But even if you just took a little bit of your portfolio and added some gold, it will benefit your portfolio. So even if you aren't in my camp, you love the stock market, you love everything else, you love the property market, maybe you love bonds, I don't know. Even if you just added some gold to your portfolio, it will enhance your portfolio. Don't believe me? Check out Chris Cole's Dragon portfolio. All right, if you haven't, or you're unfamiliar about the Dragon portfolio, go Google it, watch some YouTube videos with Chris Cole explaining his Dragon portfolio. You can see the makeup here. So you've got your normal, typical pension system portfolio on the left, and you've got the Dragon portfolio on the right, which is 24% is linked to equities, 18% fixed income, 19% gold. So nearly 20% gold, and 18% commodity trend, and long volatility 21%. So how does the Dragon portfolio perform in different, different seasons? It does really, really well. It is the portfolio that is built for all seasons. So if you're a conservative type investor, look at the Dragon portfolio. The Dragon portfolio over a long term beats most other modern portfolios. So whether you're not like me and have this macro approach, this fundamental value approach, look at the Dragon portfolio. The other thing Paul Tudor Jones said is to get exposure to commodities. And when we look at the commodities to equities ratio, it's extremely low. Now that has risen up. So this chart's a little bit old, but it has ticked up, but only a smidge, because as we know, the S&P, the Dow, has had an incredible run from its March lows, and so the commodities to equity ratio is still severely undervalued. And so I've shared in this channel how exposed I am to different commodities, copper, nickel, zinc, not just gold and silver. But speaking of gold and silver, I'm very bullish on it. The physical, if you don't have physical, get some physical. That's the first thing that I would do. Is have some physical to protect yourself. That's your insurance. It's that if the what hits the fan, if you've got the perfect analog hedge there, and then from there, if you want to invest and get more leverage, get that more asymmetrical play, then look at the gold silver miners. And then for even more of an asymmetrical play, the gold and silver explorers. I think it's such a great time. I'll be honest, and I'll share this in the next video. I've just reduced my exposure to US dollars. I've brought some of those funds back because I've just bought. I've added to a position a gold miner that I already own that is on fire sale at the moment. The same stock, around July, August last year, I had friends saying to me that they wanted to buy it, and I said, well, no, I've just sold it because it actually ran up really high, and I thought, time to take some profits, and it's now for sale, and so I'm buying more of that particular stock, and I write out of the money covered calls on it, pick up about 2% a month, so about 24% a year in premiums. It pays a 5% fully franked dividend. So, you know, nearly 30% a year in cash flow. So I actually don't want it. I actually don't want it to go up. I want to buy more of this stock and add to this position. And it's put it this way. It's less than half what it was in July, August last year. Yet they've bought another mine, acquired another mine, added to their portfolio. Look, some other big players. Morgan Stanley just valued it at 40% higher than its current price. I actually think it's valued a lot higher than that. So I'm buying it dirt cheap, writing out of the money covered calls. I actually hope it don't go up. I actually hope it falls some more so I can buy some more. Now, as I said, this channel is an Austrian economic-based channel based on sound money. That's our principles. Folks, I just can't recommend highly enough to pick up an Austrian economic book. If you haven't read Henry Hazlitt's Economics in One Lesson, buy that book, pick it up. You know, I had studied economics. I had more of a classical view of economics, but understood Keynesian and always thought Keynesian economics was rubbish. But it was when I noticed some of the most successful investors that I was following and the big macro guys that I follow, the really successful ones, keep coming back to this Austrian economic position. And I'm like, what's this Austrian economics? And so the more I researched it, you know, Austrian economists have predicted every boom and bust for the last 100 plus years. And with that kind of track record, and with the success of the people that I was following, I was like, I need to learn this Austrian economics. So it was probably about 6 years ago, I started diving into Austrian economics, and I had to unlearn a lot of things that I thought were right. And you know, central bankers, you know, right through academia, you know, Keynesian economists now are probably too right wing or too, you know, whatever, because now we've gone kind of this post Keynesian world, this MMT world, you know, and so yeah. Anyway, guys, that's my opinion. I just highly recommend. You know, I'm not an ideologue. I don't. You know, you don't have to become an Austrian economist. Just pick up a book. You know, Murray Rothbard is probably my favorite economist. I know, you know, it should be Ludwig von Mises, but he's my second. I just love the way Murray Rothbard writes. I love the way, you know, his lectures, and he's just a straight shooter. And he's got some really great, easy to read books. So, you know, I strongly recommend Economics in One Lesson by Henry Hazlitt. He's got a whole range of awesome books, Henry Hazlitt. Other than that, I recommend reading Murray Rothbard, getting some of his books. What has the government done to our money? That's a very easy little read. Anyway, guys, I just thought I'd share this. I think it'll help you. I use Austrian economics as my kind of framework. I am a value investor, and then I use options. Predominantly, I sell options, but I do buy options and trade leap options and whatnot as well for gains. But anyway, I'll leave it there. Take care, everyone. I'll see you again on another episode of Finance Uncut.